Hi, we're back with an early global view on Tuesday, October 13th, 2015. It's currently 6:45 a.m. U.S. Central Time, and we are coming to you on our regular time schedule once again because there just wasn't much to look at in terms of any data worth waiting for later this morning as there was last week. And what's out is pretty interesting insofar as it's still weak. So we have to ask, what does all this mean to the markets? Well, we had been in a bad news is good news market. All that weak data came in as the market had been rallying off the low from 2 weeks ago when it retested the more major 1866 support out of Monday into Tuesday. But then as we got closer to the FOMC, the market became more friendly. As we got closer to the employment report a week ago Friday, it became more friendly. And with all this erratic data, we've discussed already the upbreak, attempted failure that Thursday on the 1st, and push back up, signaled the market was in erratic recovery mode, even if it came under pressure along the way. And that's exactly what happened that Friday morning off the employment report, sunk back down below 1895 to 1900, back below 1988 temporarily, which was the important gap higher from back on Wednesday of this week, 2 weeks ago. And then once the employment report, really abysmal, downward revisions, real miss, came in, market still said, hey, guess what? More central bank accommodation, and has been staying firm on weak news ever since, including the release of the minutes of that September 17th meeting, from which it had set up a downside reversal at 1990, saw the minutes and how weak they were, went up anyway. So it's a bad news is good news market until today. Currently, at 6:45 a.m., this market is trading off $10 on the day, down at 20.01. Now that's kind of interesting because, again, with mostly weak news continuing, you'd think that would support the market. However, here's the dilemma for the bears, and we will see why when we switch the intermediate term charts. Unless this market's back below that 1990 to 88 sort of area, it's still overrunning the negative psychology from back into and after that September 17th FOMC meeting. Higher resistances we have to allow, though, are up at 2011, the trading high from the December contract back on September 17th, the 2015 major weekly chart down break, and the 2020 trading high of the lead contract. September 17th was the last day of September S&P future. Now, the other thing that's going to be interesting about this morning is we have the hourly MACD back down near the upper runaway band. If the market stays under pressure and this sinks below here on a sustained basis, it might well speak of a market that does want to put in a bit more of a correction. If it holds no worse than about 2,000, where it dipped down to going back to last Friday, then it might just get the bid back after this false down break yesterday below 207.5 that got knocked out late in the day with the return of the bid. We shall see. And that pretty much does it for the short-term view of the S&P 500.